My name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour, Logan Mohtashami, who's the lead analyst for Housing Wire. Going to be talking about some of the myths around the housing market and some of the work that he's done. Logan, for those who are not familiar with your background, just talk about who you are, how'd you get involved in the housing space, and what are you doing with Housing Wire?
So I've been in the mortgage industry since 1996. I retired in 2020. I created my own financial blog 2020 or 2010 to talk about the state of the housing market. And my work is generally demographically based. In the previous expansion, I've always talked about, housing having the weakest housing recovery ever. But waiting till years 2020 to 2024, demographically speaking, things will be a little bit different. In 2019, I joined Housing Wire just to be their lead analyst. I think people who followed my work over the years on Twitter know I'm just basically kind of a chart nerd. I like to talk about progression models. It's not very exciting, but hopefully it guides people to a pathway of what's going on with economic cycles, also with a tilt toward the housing market.
And of course, the economic cycle is largely driven by the housing cycle. I always make that point that historically building permits tend to fall in advance of a recession. They tend to rise in advance of an expansion. So housing is probably more of a leading indicator than the stock market, which is why it's such a critical conversation to continuously have. So I shared at the top of the nest here a pinned tweet that you have talking about why you think Twitter is wrong about housing. You talk about charts, and you've got a chart looking at home price indices. And your argument in that pinned tweet is that it's less about demand and more about inventory. First, I want you to get on the very basic level. When you say inventory, what does housing inventory actually mean in practice? How is that calculated? And why is this more based on inventory than demand?
So the way I explain this is we want to look at total inventory by active listings, right? And what I've noticed over the years is that there's a lot of speculative talk about housing inventory with, per capita basis, homes per person, all that stuff. None of that stuff makes sense. Really, you want to look at total active listings. And this is why I like to show charts going back to 1982. So we're just talking about the existing home sales market here. Traditionally, going back to 1982, we have 2 to 2.5 million active listings out there. The one time in history where inventory blew up was in 2006 to 2011. And that was a credit boom from 2002 to 2005, and then a credit bust with forced selling. So that was the anomaly period. If people are familiar with my work, I really focus on credit risk profiling. And in 2005, 6, 7, and 8, people were filing for foreclosures and bankruptcies at a higher rate, all the way up to the recession in 2008. Then the job loss recession happened on top of that. So when you look at credit profile charts, you can see that the housing market started to get stressed in 2005, and housing peaked in 2005. So it explains the velocity of inventory. I think 2007, we got to about 4 million active housing units. We had forced selling, credit risk selling, bankruptcies, foreclosures, short sales in a downward market on top of a job loss recession. That's different. Traditionally, what happens, we call late cycle lending. The risk is the people that buy the homes toward the end of an expansion, they have a very low down payment. Maybe their credit profiles don't look good. In a job loss recession in the following year, those are the people that would, in theory, file for a short sale or a foreclosure in any kind of meaningful way. None of that was happening post 2010. What the one thing we did good in this country is that we made housing debt boring again, which is basically a very simple process. You have a fixed long-term debt payment. From 1985 to 2007, people were living in their years 5 to 7 years. From 2008 to 2022, the average housing tenure is about 11 to 13 years. In parts of the US, it's 15 to 18 years. So people just bought a home. That's all it is. It's the cost of shelter to your own capacity to own the debt. Then we had 3 waves of refinancing. So this fixed payment just got better and better cash flow. People's wages rises. So the home profiles or the homeowner's loan profiles look excellent. Then 2020 to 2024 came, right? So the demographics of housing are a little bit better. So when we talk about this as an inventory issue, what I like to show people is if you look at active listings from 2014, they were slowly falling every single year, right? Even in 2018, when we had 5% mortgage rates, Total inventory didn't show any growth. So there's something different about the last 10 years that's a little bit different of inventory data going back to 1982. And this is why I stress look at active listings. Everything else that people talk about on Twitter makes no sense whatsoever because it's the active listings that matter. So here comes 2020, all right, just before COVID actually hit us, housing authentically broke out. It's the February data. The problem is we got that in mid-March, right? So we're all dealing with COVID. Housing starts broke out, housing permits broke out, new home sales broke out, existing home sales broke out from the pre-cycle trend. Purchase application data finally got to 300, which was a long-term target of mine in the previous expansion. Then COVID came, right? Everybody went to housing crash mode. The homeowner is in a better spot. So then, of course, forbearance came in. Demand paused for about 6 weeks and then quickly came back to trend. So when we talk about this is more of an inventory issue, I tell people if you look at 2020 home sales, it's only 130,000 more than 2017 levels. So this is not like a credit or sales boom. In 2002 to 2005, if everybody sees the credit debt profiles, you can see this big expansion in home sales, credit, prices, starts. None of that was happening here. But the problem with housing is inventory cracked below 1.52 million. And the reason I use that level is that historically, going back 4 decades, we've never been underneath that level. We had it briefly in the early 90s, except we have more people now. We have more people looking. Mortgage rates are lower. So it becomes a problem for housing because this is the first time authentically we have active listings below 1.52 million. Then on top of that, you have the demographics, right? Millennials, ages 28 to 34, biggest age group ever, with low mortgage rate. It was a savagely unhealthy backdrop for prices. But everyone's prone to 2008, right? They're prone to think housing has to crash. Educated, positive cash flow homeowners have to sell their homes at a major discount. Not the case, right? So inventory gets worse and worse. In 2020, you want to look at October, right? The reason we talk about October a lot is that housing inventory is seasonal. It rises in the spring and summer, then it falls in the fall and winter, right? So in October of 2020, guess what? It was falling back to levels we have never seen, right? And rates were still low. So in 2021, when I went on Bloomberg in January, he said, hey, listen, don't worry about the forbearance crash. Worry about unbelievably overheating housing market because inventory broke again. We saw what happened last year, right? 20% home price growth. Then in October of 2021, it happened again. We broke inventory lower on a year-over-year basis to new levels that we haven't seen. So here's 2022. Sales are falling, right? Case-Shiller data lags, of course, but it's up, almost 20% year over year. The weekly data from Redfin or Realtor.com is still showing median list prices double digits year over year. And then if you look at the existing home sales report, the last one, we still have 13% home price growth. This is not normal in a normal inventory channel, which goes back to 2 to 2.5 million. And if we just had that much inventory, we wouldn't have to even deal with some of this unbelievable home price growth. In fact, we can even make a case that prices, in a sense, if we started at 2.5 million, could probably be down currently, not up double digits. And that's why I always say that if you look at 2001 to 2005, total inventory was growing. Total sales were growing because it was booming. It was a credit boom, right? It was an exotic loan debt structure credit boom. So monthly supply nationally was always under 5 months. But that was when inventory was rising near to 2.5 million. Here, we were slowly falling every single year from 2014 all the way here, and now we broke to all-time levels. So this explains the pricing because the days on market is simply too low. When I talk about days on market, traditionally we have 30 days plus for the existing home sales market, right? The process of buying and selling a home, right? A traditional seller is a buyer of a home, right? 75 to 82% of the time. So they have to put their homes on the market and they feel comfortable no matter where rates are to buy another house, right? And that's why the inventory channels kind of stay between 2 to 2.5 million going back 4 decades. Well, guess what happened? Inventory kept on breaking and breaking, and the days on market is a teenager. Nothing good happens in the housing market when the days on market are a teenager or under. So we see this unbelievably horrific home price growth every single year. And even this year, We just need inventory to get back to even 2019 levels, even though 2019 levels is just the 4-decade low, 1.52 million to 1.93 million total inventory, active listings, NAR. You could have a stable housing market. We saw that in 2018 and 2019. Even though nominal home prices were still growing back then, still it was not this. So this is why part of team higher rates, there's nothing else we can do currently that could get the housing market back to normal unless mortgage rates rise. Back in February of 2021, when I talked about this, everybody pushes back because they go, no, that we're not recovering in the economy. There's forbearance, housing. People have to get off of that 2008 mindset. Homeowners are fine. They look great on paper. There's nothing wrong with them. Renters, on another hand, is going to get impacted by housing inflation in a detrimental way. But homeowners have been in their house for a very long time, and they just refinance. They'll be okay. The inflection point is, and this is a big part of my work in years 2020 to 2024, is that if home prices only grew at 23% for 5 years, we would be okay. Because with wage growth and where rates are, it would still be a stable market. I'm not even a housing boom or credit boom or even a construction boom person, but that will keep things at line. We smashed that in 2 years, and we're still showing double-digit home price growth. Nothing good happens from this, so we need rates to stay high. We need inventory to get back to normal. We're still, even today, we're at 1.26 million NAR data. And we just get back to near 2 million, we'll have a more stable market. So we're just working our way back. But we don't have the sales or credit boom during the housing bubble years, which had less price growth. We had less home price growth during the housing bubble years than what we saw in the 2.5 years doing this. And it's not because sales are anywhere close, right? It's not because institutional buyers that went from 0.4% to 2.5%, that's not changing the market. We literally, on every single data scale we've had going back 4 decades, we just broke to all-time lows at the worst time possible because more people are looking for homes. Forced bidding, not a good thing, and prices escalated vertically. And that's why I tell people, go look at the Case-Shiller Index. You see vertical pricing. That only happens unless you have an unbelievable sales boom or you have a shortage of homes. We don't have a shortage of homes. Sales are declining. We're about 1.4 million off the peak of the existing home sales report, and we still have this unbelievable home price growth, which is savagely unhealthy.
All right, so there's a lot of directions to go with that. First of all, is the makeup of the inventory different than in prior cycles in terms of average homes? The tier of income or wealth that can afford it. Talk about some of the dynamics of the inventory relative to the past.
I mean, most inventory is single family. I mean, that's just what the people have been producing for over the years. Multifamily construction apartment, that's a whole different a segment. We definitely are seeing a growth in multifamily apartments, but that has nothing to do with the active listings of single family homes. Condos, townhomes, we haven't been really building that out in anything noticeably. But here's one thing to think about. In 1975, the median square foot was 1,500 for a new home they were building. By 2014, it was 2,700 square foot. So we've been building bigger and bigger homes as our family sizes have been getting smaller. So naturally, the product that we've been building for people, it's perfectly fine for a family of 4. The older homes that have been in stock since the 20s, 30s, 40s, and 50s, those things, there's always tear downs. People that buy cheaper, smaller homes, they have to move. So when we think about years 2020 to 2024, what's different? Ages 30 to 39 are bigger. So kind of the running skid I've done in the last decade. Well, we're not very complicated people, right? We rent, we date, we mate, we get married. 3.5 years after marriage, we have kids. People get married at 28 to 29. So the ages 30 to 39, you need a bigger home. So even if there was no COVID, even if there was no work from home model, more people would have moved, just naturally to a bigger home because naturally you're going to have kids more. Then the work from home model happened, and that is the biggest nuclear bomb change in housing economics that I'll ever see in my life. you can, in a sense, move to any part of the US, still have your job. You're obviously not going to make as much, in these hot coastal cities, but and you could buy a bigger house. Especially California. California, everything is cheaper to every person in California. So you can go around. So that exported housing inflation. So all these areas that we have seen that were getting an influx from people from these big states, housing inflation took off. And it's not, again, we're not talking about a credit or sales boom. The average homeowner income is 100,000 right now, but you have dual household incomes, right? That's a game changer. When people get married, they have two incomes. That gives you more buying power. So it makes sense that millennials are the biggest home buyers in America, right? Their household formation is picking up. They have two incomes. They tend to buy homes, right? Then there's like 1/3 of the society that are lifelong renters, right? And then guess what happened? Rental vacancies have been falling for many years, and you get housing inflation on both sides. So this is a historic event that we've all basically watched. We saw housing inflation take off without the demand being anything that we saw from 2002 to 2005. So you get hit on both ends, which is, again, part of the savagely unhealthy housing market. If you're a homeowner, it's fine. Guess what? You have a fixed payment. If you're a renter, boy, you're getting hit on every side possible. And it's more of an inventory product. If you look at the historical data, it's very easy to see, and you can easily see that sales are nowhere near what we saw. Even if you look at new home sales today, right? New home sales came out 590,000. We had 1.4 million new home sales at the peak of 2005. We are below the 2000 recession levels. We are actually back to 1996 levels, right? So it's just a different marketplace because we never had a credit or sales boom. It's just the average, trend line of home sales that we've seen every single year. If you look at 1996 and up, it's really rare in America to have existing home sales under 4 million, right? So you just add a little bit of a demographic boost and that's it. You just get a little bit more home sales, and everyone had to pay the price with vertical pricing. And it's not easy to get that sticking housing inflation off. We could see that this year because inventory is still working its way back up to 2019 levels. And once we're at 2019 levels, I could take the savagely unhealthy housing market. I'm perfectly fine. I think the housing market will be much better when everything gets back down to, or gets back up to 2019 levels.
Okay, now one of the narratives that's out there is that maybe some of the reason why inventory is so low and these prices are so elevated has to do with what seems to be a larger percentage than historically was the case of institutions, most notably BlackRock, right, buying up properties, buying up homes. I'm curious to hear your thoughts on how that dynamic may be impacting some of this, and maybe if people are overestimating the impact of some of these institutions just buying up properties.
We've always had a group of investors. They tend to be mom and pop shops, right? Historically, we see that in the data. The large institutions, again, we went from 0.4% in 2020 to about 2.5%. That's it. The iBuyers, right? It's roughly like 1% of total home sales. So the reason I don't like the BlackRock's buying all the homes, because basically, if you could just visually see it in the data, it's not even remotely close. Millennials are the biggest home buyers out there by far, like not even close to what large institutions. So the problem with making BlackRock like buying all the homes, that makes it seem like housing is invincible. So my kind of thing is that mortgage rates matter. Right in the summer of 2020, I said, "Hey, listen, if the 10-year yield can break above 1.94%, housing can change." Okay, but that was the summer of 2020. Guess how much home price growth came after that period. So here it is. Rates are up, sales are down. Where's BlackRock? Not even close. They never had the guns to be able to buy most of the homes out there. So it's a class warfare tactic. We see it all the time. But if anybody looked at the data, you can't say that 2% increase from 0.4 to 2.5%, they're the majority of the buyers. It doesn't make any sense. Investors in itself, right, especially those buying to rent, like people go, why aren't investors selling their properties? Home prices are up so much. They look at cash flow. Those are mom and pop investors. If you look at investor data, 90% of them, it's them. They buy, they get the cash flow, rents are up. They're looking great. They like, why would I? This is how I'm retired. Why would I actually sell the property to go to cash? right? So two different kind of perspectives, but I never liked the investor because it made housing seem invincible. Like the really super bullish housing theme was always based on investors will come in and buy up. Guess what? Mortgage rates went up higher, sales are falling, they're not picking up anything, right? And part of the higher mortgage rate premise that I had, and literally this is the quote I give to the media, we needed higher mortgage rates to put the home builders, home sellers, and investors on their ass because they had way too much pricing power. And when you have way too much pricing power because total inventory levels, you can do whatever you want. So the pushback you always get, well, we won't be able to build homes. Guess what? If we need 3 to 4% mortgage rates for the builders to build while existing home prices are up 15 to 20%, that's not a good trade-off, right? So once rates rise, guess what happens? Things change, right? Sellers change, right? Home builders are like, okay, I can't run up the prices. Just look at median sales price for the builders. They pushed that to the extreme. They were making so their profit margins looked excellent. Didn't matter where lumber was or anything. They were passing that to the consumer. So the only mechanism we have here in America is for higher rates. Not popular, trust me, it's not a popular theme, but in this kind of situation, it's different than what we saw from 1982 to 2019. We just got to a very bad level on inventory. And human beings are human beings. They're going to do what they want to make it financially worth for them the most. So they have no checks and balances. That's why rates had to go higher. That's why rates have to stay higher to create some kind of balance. We see it with the builders. We finally see it on home sellers, but it's slowly working itself up. Housing doesn't have the velocity of stocks, right? Margin debt with stocks moves one to one. Housing is painfully long, but in time, right? Inventory grows, more days on market. And when we get back to 2019 levels of total inventory, even though that's a 4-decade low, that's good enough to keep things at bay and normal. Because what we had in the last 2.5 years, none of it was normal.
So I had Bill McBride on a space a few days ago, and one of the conversation topics was around this idea that one of the reasons why inventory is also low is because a lot of people turned to housing as a way of generating yield when there was none, meaning buying up second, third, fourth homes and then renting them out or doing Airbnbs or Verbos, whatever it would be. And presumably I'm going to assume, I haven't looked at the data, that's sort of a dynamic where you can argue that's kind of at an all-time high, right? The sort of the number of second, third homes that are used for cash flow generating purposes. Um, if that's the case, Logan, it sounds to me that it's more than just higher rates. That the way you get more inventory is by causing forced selling of non-primary residences.
Well, here's the thing. I think there's 8 million more owners of rental properties than what we had in 2008. So rent inflation took off. Rental vacancies took off, right? So if we're going to pit homeowners versus renters, well, let's just kick all these investors out, put all their families on the streets because we want more home buyers. Well, if rental inflation was not kicking up, then that's a case. We simply didn't have enough product for both. So imagine what rent inflation would have looked like if those 8 million new investors didn't buy those properties and there were homeowners, right? There has to be an equilibrium where, okay, well, home price growth will slow down, but rent inflation has to take off, right? So both took off at the right time. And if people looked at the rental vacancies, you could see it too. So we have almost 143 million housing units in America. So we have 8 million more kind of investors. Still, rent inflation took off like crazy, right? So there just wasn't enough product. And if anybody goes sees the census data, you could see that this year's 2020 to 2024 is just like this once in a lifetime unique event of a demographic push. So you get inflation on both sides. And we were always told that we should expect a major housing deflationary event from 2012 to 2019, even though we saw the inventory falling, we saw rental vacancies falling. Nobody cared. Nobody literally cared about that data. And here it is. And we're all paying the price for it. So if you want to look at Airbnb, so out of the 143 million housing units, Airbnb is like 660,000, right? If you want to say, well, there's 10 to 15 million vacant homes or whatever, we're talking about active listings going back 4 decades roughly always being about 2 to 2.5 million. That's the only data line that matters on the inventory. Anybody could come out with so many forms of data out here. That was breaking starting in 2014, and then rental vacancies were breaking. So we just got caught. We got caught in a very bad place because household formation was picking up. The biggest housing demographic patch ever came in 2020. Rents went up, home prices went up. We don't see record-breaking home sale demand. You see it in the new home sales data. You see it in the existing home sales data. And I always say, 2020 home sales was only 130,000 more than 2017. So why did inventory keep on cracking? People are staying in their homes longer. We do have rental properties. We just got caught. And there's really no other way but higher rates to change this. And we're not going to have like forced credit selling like we saw in 2005, 6, or 7, 8. Where foreclosures, delinquencies are really at all-time lows. We're going to have an increase in some of that because the foreclosure process is coming up. But you can see a clear divergence from what we had from 2005 to 2008 to what we had from 2012 to 2022. And that's part of the problem, right? And there's really nothing we can do about it. We're not building. The builders are done. The cycle's over, right? The housing recession already started. Once the 10-year yield broke above 194, that was it for them. They are going to slow down on construction. I think out of the 9.3 months of supply out there, like a little bit more than 6 months is homes that are under construction. Like 2.2 months hasn't even started. They are not going to bring a shovel to that dirt on that 2.2 month supply. So they're just going to wait, and we're stuck here again. And that's part of the housing dilemma, which has been part of the data we could see for a very, very long time. And there's no real easy solutions. And I actually agree with what Powell said. We need a housing reset. We need something to stop this because we can't have 15 to 20% home price growth every single year. We don't want to look like Canada, New Zealand, Australia, Switzerland, the UK, even France. Home price growth versus per capita income here in the US is reasonable, but we had the potential of this double housing inflation, which it already kind of happened. So it is what it is. Hopefully they could finish up the multifamily construction, get some more inventory for the rental side, and we'll deal with the rest later. But that is a huge vertical pricing pain that we had to have since really it started in the fall of 2020.
And real quick before I bring in some of the audience here, but because you mentioned Canada, how much of the dynamics in terms of global home prices are because of the same aspect as far as inventory? Meaning, in the case of Canada, for example, is it a similar parallel or is it more demand driven?
Here's the problem with Canada's home prices, and the reason I say we can never look like Canada. Canada is really driven by two cities. And some of it is spreading around everywhere. But they have two cities that have a lot of foreign buyers, and their mortgage market is much different than ours. So their home prices versus their per capita income looks insane. But it also looks insane in Australia. It looks insane in Switzerland, especially New Zealand. These are smaller countries with different dynamics. And again, if there was more supply, you wouldn't see any of this. And that's why I stress that if we just get back here in America, just the 2 to 2.5 million, we can see that, since we can't have a credit boom, I fundamentally do not believe the US could ever have a housing sales credit boom ever with where our lending standards are in. We'll never see what we just experienced. The problem is we got to get from here to there. Those other countries, smaller countries, in Canada's situation, really, if you take Toronto, Vancouver out of the last 15 years, but those homeowners, in the sense, are stable until their rates rise. I mean, their mortgage market is much different than ours. They don't have long-term fixed debt products. Here we do, so that's part of the issue. Here in America, homeowners they're doing good. I mean, why would a seller move? A seller needs a reason to move, and they traditionally buy another home. So in a sense, the house inventory is a wash. That's why you have that range of 2 to 2.5 million going back to 1982. So much different marketplace in Canada and New Zealand and Australia than we have here in America. We're a much bigger country, and we exported housing inflation in a terrible way here, where you see some of that in the Canadian markets where it's just too expensive in Vancouver, Toronto, and they just go over here. We just have so many more cities. We have a much bigger population. Total different dynamics here. I do not believe we could ever look like Canada or Australia just because of our diverse country. Um, there is no such thing as affordable housing. It's an interesting, creative, mythical thing we've created in America or just in economics. But what does affordable housing look like? It would have to be constructed based on the incomes of the person that couldn't afford a house, right? So 2/3 of the population are homeowners in a sense, but you really have to be a middle class or dual household income to afford to buy a house. Like people say, like, I live in Southern California. People go, "How the hell do people buy homes here?" Well, they make like two, three, four, $500,000, and the people that live by the water are stupid rich. But everywhere else, housing in a sense was always affordable if you look at per capita income and home prices and where rates are. So we never really had like an affordability crisis from, let's say, 2002 to 2019. This is why millions and millions of people can buy homes. But that 1/3 of the society are lifelong renters unless they become a dual household income. So in a sense, what is affordable housing? It's only based on what your income is. Like for people in California, if we had our incomes, everywhere is cheap. I mean, when I went to Texas last year and I just saw all these single family homes, I'm like, oh my God, this state is so cheap on this housing. It's only because we're using California incomes, to second. So it's really based on the income factor. And this is why there really isn't anything like a housing affordability. You see these companies that are building, residential housing units for their workers. I think one high school bought made $1,400 rents for their products. That is a renter's situation, but for home buyers, really, there's a certain group of people that make the kind of income that buy the homes. So in a sense, they'll be okay. I just think that 1/3 of the society, they're never going to be home buyers. It's just they simply do not make enough income. They have to be part of a dual household income to even come close. So if you want to think about affordable housing, those companies that are building units out just based on the incomes that they pay that is something that is a workable premise. But affordable housing is what is it a $200,000 home now? Who's going to build that? The builders aren't going to do that. The builders are like, hey, listen, we're going to build as big as home as possible with all the bells and whistles, and we're going to price that down. So their main competition, and this is actually something I've talked about for many years, the builders were never going to oversupply the housing market. Every decade that they're alive, they just kept on building more and more homes. That existing home sales market, that massive, is their main competition. So those homes are, in a sense, more affordable than the new home because the new home is more expensive, have all the bells and whistles. So affordable housing, in that sense, is compare the apples to apples of an existing home versus a new home. But it really is income based. So if you really want to address affordable housing, you have to build homes tied to people's incomes because there are certain jobs that just aren't going to make $100,000. So the average homeowner family makes $100,000. Mortgage rates are low. Millions and millions of people buy homes, but that affordable housing story on that bottom end, that market left a long time ago. So you have to build houses based on people's incomes. Of course, people move jobs or anything, but there's a certain group of people that just do not make the kind of money that you can even try to build an affordability house unless you tie it to that income.
But by the way, one job that definitely is not going to pay $100,000 is being a Twitter Space host. And so maybe those that are in the audience can follow me as a little bit of a thank you, as well as Logan here, who's obviously kind enough to spend the remaining 25 minutes talking about this subject.
So, no to this answer on investors because the percentage of investors of Wall Street doing bulk buying, that was a 2009 to 12 story. And there's actually data on this. They bought distressed bulk, let's say 26 cents to the dollar, and sold it within less than 3 months. And then as that product was selling, their percentage, I even have the exact chart for large investors, they kept on falling every single year from 2012 just because they didn't have enough product. And by 2012, the monthly supply of housing supply actually broke under 6 months. So the reason their percentage declined is because they kind of milked out what they were going to do. They weren't looking to buy to become investors in the sense of renting. And I have a great stat for this. From 2011 to 2017, there was over 35 million homes bought. Guess how much Wall Street bought with pension funds altogether? 200,000. That was it. Now, mom and pop investors, that's a whole different ballgame. They're like 90% of the market. Those people buy, they borrow cheap and they rent out. Those people are the big players. They've always been the big players. But from 2011 to 2017, the pensions and Wall Street firms bought 200,000 homes out of the 35 million. And to kind of rent out, right? They're just not big enough. The profit margins off foreclosures, right? The distressed buyers, there's where they were bigger. In a sense, they were cash buyers at that point. But the thing is that the supply kept on falling and falling. That's the only reason they kind of left. So if people wanted to target or let's target homeowners versus renters. Let's kick all these renters out of the houses because investors have it and let them fight for themselves so we can get more existing homes for home buyers. That's just a very, very hard thing to say when rental vacancies were falling since 2012. So that's the thing about the Wall Street firms. They never were that big because they can't be that. They don't have that kind of capital. But mom and pop investors, they run the show. I mean, that is a whole syndicate. I don't know if people realize how that works, man. They are just cash flow, rent. That's all they look for. That's different than what Wall Street was doing during the housing crisis years. Cash buyers are hub. They flipped it out. 90 days, they made the profits. They try to stall that out by giving rules that you can't flip after 90 days. It still didn't matter. They still made so much money. But the reason the percentage decline fell is just because the product was moving out. So that's why if you look at the percentage of large institutions, there's a chart I have of that. It kind of started falling, but it picked up again in 2020. They just simply aren't big enough. The biggest home buyers in America are millennials. If the millennials didn't exist, we're pretty much Japan, right, at that point. So the bigger buyer always matters more, and that's why mortgage buyers run the show. When rates go up, we saw that in 2013 and 14, rates went up, mortgage demand fell, home sales fell. Prices still stayed up because inventory is so low. We saw the same thing in 2018-19. 2018, existing home sales went from 5.72 million all the way down to 4.98 million in 2019. Mortgage rates went up, mortgage demand fell, home sales fell. So they are the bigger buyers. They've always been the bigger buyers. But investors, if you wanted to attack the investor mindset, then somehow we have to convince people that we have to kick these people out of their homes. And that's the problem. And this is why it never really happens. There's no solution really for the government to say, we want more supply, so your family has to be the consequence. So we're going to make it where these people put their homes on the market. And trust me, it's not like they didn't look at that, right? It's just politically, you can't have a war between homeowners and renters, especially renter families who don't make the money of home buyers. And this is part of the housing dilemma. Like, how could you, as a congressman, say, we want to make sure these investors all sell their homes? And people have talked about the carrot and stick. Let's make it tax-free. Home investors, sell your homes. You don't have to pay any taxes. Could you imagine as a politician saying, oh, by the way, investors, you've done great. We'll make sure, kick those families out. And I think that's the missing link of this conversation and why the tax policies kind of don't change. And that's why it's really a tough problem. You can't tell a family, well, we're going to help the home buyers of America who make more money than you. We're going to make your investors kick them out, and there he goes. And that's the problem with the rental vacancy. Like, literally, rental vacancies were falling for years. Nobody paid attention to that. Home inventory was falling for years. Nobody paid attention to that either. So why would it be a surprise that, oh, well, guess what? We're total listings inventory for rents and home buying is at all-time lows. That was going to be an inflation problem, not a deflationary problem. So when a recession comes, a job loss recession comes, renters are the ones who get hit first, always, right? The people with the least amount of education, those who don't have a high school degree, are the highest unemployment. There's your supply that will come from them. Homeowners, on the other hand, one of the reasons why the forbearance crash bros missed in 2020 and 2021. If anybody read the jobs data by October of 2020, those who were made $60,000 or more were already back, right? So majority of homeowners were already fine. It's the rental issue with unemployment, right? Because we're a service sector economy. Guess who's going to get laid off first, right? So yeah, a job loss recession can create more units for definitely, because the higher unemployments will most likely have renter financial profiles. But the homeowner themselves, they're great. They're doing wonderful. They're sitting in their homes unless they lose their job, right? And even with the nested equity they have, if they lose their job, they can't make the payment right. If they can't get the job back, of course they're going to sell their property. But that needs a job loss recession. And there's going to be certain, like remember the oil boom and bust, the Dakotas? Remember all that production of homes that were being built in the Dakotas for the oil boom? Guess what happened? Dollar got stronger, PMI recession. Oh boy, we just got a glut of those homes up there, right? So there are sectors of the economy that we always see, like anything with durable goods. I mean, we see all this the Peloton effect, total huge demand for Peloton during the crisis, collapse in demand, 20% layoff. So those people, yeah, if they're renters, most likely they have to get another job. So the labor market dynamics with supply is always critical. It just depends on how much, because when it comes down to it, most people are always working, right? Most people are always paying rent. Most people are always paying mortgages. Now that the mortgage debt structure was fixed after 2010, you focus on renters first. Then if you want to focus on homeowners, but really homeowners just have so much more of an advantage than renters. One of the worst takes I've seen on Twitter in the last, I would say, 2 years is this notion that housing units under construction is like a really big deal. So the way I handle this is that I'll retweet those charts and then I'll ask people, how many units do you think is actually here that the builders aren't going to have a buyer for? Because we're talking about single family construction. Multifamily construction is different. They're gonna finish those things and go out there. That's a rental inflation issue, which we desperately need. But I always ask people, do you think the builders have like 900,000 homes that haven't been sold? Like when you go on contract, you're basically, the house is bought. You just have to wait. So it's the cancellation rates, right? So here we are. It's literally almost August in 2022. We have 9 months, 9.3 months of supply, and we have 0.86 of finished product, right? So the builders aren't going to, this is like, I think people are confused about that chart. Those are not like homes that are just going to flood the market and the builders are going to sit there. Those are homes that are on contract. So it's the cancellation rate. And then, if they have to find a new buyer, then they wait it out, price cuts or whatever in that sense. That is not flooding homes. This is actually something I've written about for years. The new home sales sector isn't a very big high velocity. So look at the total units available, right? There's almost 143 million. Out of that, let's say 800,000 homes, about 590,000 homes sold. That's really not that much once the home is finished, right? So there's six months in construction, then there's 2.2 months that isn't even starting to build. The builders are really, really good in managing their supply. They will literally stop construction to make sure. And I think 2018 was a great example of this. Mortgage rates went to 5%. Literally, one of the builder CEOs said, it's the worst fourth quarter since the great financial crisis. They go drama quick. But the housing completion data that we've seen post, actually 2019 just hasn't kept up pace. So this is why you don't get a lot of inventory. That's why I say the number, if you really want to focus on inventory, you don't do the homes under construction, or you just look at active listings of the homes out there. And the reason I like to do the NAR data, I know a lot of people, Realtor.com, Altos Research, they have single family only. But if you look at total listings of the NAR data and you go back to 1982, you can kind of see, right? It's pretty normal. We get 2 to 2.5 million. So let's say there's 200,000 homes that the builders, can't unload in that first 3 months. Out of 143 million, that's not a lot. So it looks crazy on the charts, but people have to realize the multifamily component of that is going to the rental side. Then those single family homes are under contract. Then you have to take the cancellation rates, and then you have to see whether the builder's buying, are rates coming down. This is the reason why inventory is still below 2019 levels. The velocity of new homes just isn't that, powerful. Now, if we go back to 2002 to 2005, what happened there was single family starts, new home sales, construction, permits, everything, completion data, they all moved perfectly in line to a credit bubble. About 1.4 million new homes were sold at the peak of 2005. Guess what? We had an 82% crash in new home sales, right? And it wasn't even, that was just one aspect of it. We just had the weakest new home sales recovery ever in history, from 2008 to 2019. So we should have the weakest housing starts. Like, people think like the builders are like the March of Dimes. They're here to build society. No, they're here to make money. So of course they weren't going to build homes. So that number of homes that are in target, what you always want to do, you ask people, how much supply do you think is actually there after the builders like finish the homes and then they can't find a buyer for them, and that takes like a 2 to 3 month process if they don't close it right there. It's just not a lot. And that's part of the reason. That's one of the things I've always kind of written about. They are super mindful about their supply, right? And don't even think they're going to start building those homes that haven't even started yet. They're going to make sure to wind out those products. So when they're finished, and let's say my original buyer's canceled, let's see who could come in. Do I have to cut prices here, incentives here? I could give my buyer a 10-year arm of four and a quarter. Okay, they've got that whole system kind of perfectly tuned up. So that's why you don't see the velocity of inventory, because unlike the existing home sales market, a new home goes into contract first and then they build a home. So you only technically you kind of want to lock the rate just when you're about to occupy the house. So the occupation rate is based on a paperwork that says, hey, you can move in. And that's why the velocity of inventory isn't that much. And think about it. The completion data tells you. I mean, think about how sad the housing. I encourage everyone, go look up Fred and go look at housing completion data. It's terrible. It's gone nowhere for years. And now the builder's like, hey, that other supply we haven't even started, we are not going to touch that. So you're looking at right now authentically about 6 months of supply that's under construction. Let me tell you, they're going to slow that process down. They're going to hope for rates to come back down just to lock somebody in out there. So that's why that data line is not as big as people think. In terms of regional, of course, part of the problem with having work from home is that we've exported so much housing inflation into other areas. We see it in Boise. We see it in Montana. Montana had like 40%. Austin had 100% home price growth like in 2 years. That is not normal. Like, we don't have any home sale data that looks anywhere to the top of 2005. So we've inflated home prices from, we exported housing inflation. So the regionals have been hit. But again, when you think of housing, you think of homeowners. They buy a home, they have a fixed payment. As long as they're working, they're fine, right? They're not going to sell their homes. You don't sell your home to be homeless. You sell your home, if you're a primary resident owner, to either buy a bigger home or buy a smaller home. Or let's say you lost your job, you have to rent because you don't have employment. That process takes time once the job loss recession happens. Then, of course, the government's going to do what they can to try to facilitate homeowners to stay in their home. I don't think we'll ever see a blanket forbearance like we saw during the housing market. I don't know if they'll even do something in a minor fashion, but the goal for the government is to keep people in their homes. And that is a problem with kind of the tax incentives. If people say, well, let's go after investors. Okay, we have to kick out 20 million households. That's always been the problem on the political side, because you can't pit homeowners versus renters as a politician and think you're going to get away with that, because you know what's going to happen. They're going to say, oh, it's class warfare. They want to give investors tax-free capital gains to sell their property and kick these people out. And that, people say, why don't they do something? Well, when I talked about mortgage interest deduction should go away, boy, I have never got more hate mail in my life than when I wrote that article. The system is designed to keep people in their homes. The government loves the premise of forced savings, which I'm not a big fan of. But That's part of the reasons why you don't see kind of tax policies really change. People can talk about it all they want, but it all comes down to, if you are a politician, do you want to kick renters out of their house just to create more supply for home buyers? Tough thing to do.
I've got a hard stop in 5 minutes, but I want to go back to Patrick. And again, everyone that's here, please make sure you follow Logan, who's obviously got a hell of a lot of passion, which I think is fantastic in the way it comes across on Spaces, and obviously a lot of data and interesting ways of framing things.
Do you see the housing dilemma we're in? How do we break this? I literally could not think of any way just to break this downtrend that we have seen since 2014, unless rates rose because we can't have a society that has 15 to 20% home price growth every year, and then the builders say, oh, well, we're not building unless mortgage rates get back down to 3%. So the only other solution is the baby boomers all have to die. And that's been a big theme of mine for a long time.
Can I quote you on that?
Yeah. Oh, yeah. Listen, we have to also be mindful. Millennials are the biggest home buyers in America. So it's not like they're not buying. They've been starting buying since 2013. They're roughly 50% of the market. They just needed a little bit. But the boomers, the baby boomers, man, they just don't sell. And they literally, for the future, I mean, what I'm thinking is more Gen Z. For the future to buy, the baby boomers have to die. And that's the end of this decade. No country has a Dorian Gray labor market, and nobody lives forever. But clearly, that supply is more of toward the end of this decade. And this is why I stopped my housing discussion from 2020 to 2024. I've separated my work for years. 2008 to 2019, weakest housing recovery ever. We'll see that. But 2020 to 2024 will be different. And after 2024, we'll have a different discussion. But the risk was housing inflation could be really bad, not just for home buying, but for rent, because of all the dynamics we have seen, going back to 1982. And that's kind of why I like showing those 1982 charts, so people could have a perspective of how the inventory channels work for the active listings out there. So, yeah, it's tough, but eventually they will die. They will pass their homes on to their kids. Right. And their kids will do whatever they want with them, rent them out or sell them off. But don't look for the builders to help you too much here. They are going to slow housing as much as they can, because what happened after 2008, my work is different. I actually don't agree with people when they say that we didn't build enough homes. We built enough homes based on the demand curve for the builders. Right. They missed estimates in 2013, 14, and 15, and then they had a supply spike in 2018. So, of course, they're going to not build. They're just going to build only how much they could sell. So, kind of rule of thumb, as long as monthly supply on a 3-month average is under 6.5 months, they'll build. Like when it's under 4.3 months, the builders, they're on drugs. We only held that under 4.3 months for a very brief time. So they're just going to slow, because guess what? Those homes will come eventually, but it's going to take death. And that's just the reality we're in. And that's something, 2030 and on, based on, people's living. The first baby boomer hit 62, I think, in 2008. I don't know if you guys remember the whole silver tsunami marketing tactic that every baby boomer was going to sell their homes in 2015, and home prices had to come 70% down because no millennial could buy. That obviously failed. So you can't escape death. And give it another 10 years, we'll see a different situation then.
I'm not sure if I should be rooting for that or not, but I think that's a good way to.
It's just the reality of where we in.
No, that's fair enough. Again, everybody that's here, please make sure you follow Logan. Hopefully, follow me. I appreciate those that were asking questions. This was a phenomenal conversation. Logan, first time you and I were talking, love the passion, love the knowledge that you brought to the conversation, and everybody enjoy the rest of your day. Thank you, Logan. I appreciate it.